All right, so we're going to talk about Canfax. It's a division of the Canadian Cattlemen's Association, if you're not familiar with it. And basically, we track and analyze and collect and distribute basically anything we can regarding the Canadian cattle industry and cattle markets and cattle prices. So it's been an interesting job in there for 7 years. I started in 2010, almost just as we turned the corner, and had a really exciting five fun years, and then this happened, and here I am talking about current markets and conditions. And it's been a pretty tough job being a market analyst, I think, in this. I don't think anybody's going to claim that they predicted $3 plus calves at 3-4 years ago, and I think some at points we fell in half within a year. So there's been a lot going on, and it happens so rapidly. And really going to go over some of the background and maybe try to explain just what happened, and from there we can kind of look forward as to what we see. It's important to put into perspective where these prices are today. We're still relatively strong, but certainly after coming through some of those big booms, there's been a lot of losses on those expensive cattle, and we've got to readjust our expectations of just where value is, and that's what these markets are trying to figure out. Going to start a little bit, just a couple thoughts on some global markets. Obviously, actually just sitting there, I was thinking it's a little bit different in Ontario. Mostly cover a lot of the West, and they're very export dependent, whereas out here we get here and a lot more import dependent. So, but nonetheless, we are definitely affected by a global marketplace. Not only cattle, competing meats, meat alternatives, just general trends and consumers that drive the market. But we look globally, so talk a couple thoughts on global markets. Really going to focus, a lot of this is on the U.S. market, North American market that we operate in, cover off maybe what's happened down there, and then talk about Canada and local market dynamics from there, just as an outline of the presentation. But if we look globally, this is beef, pork, and broiler meat over the last, about 6, 7, 8 years of what we've done. And basically it's showing beef production globally is quite flat. Whereas we can see pork and broiler meats kind of had a growing trend, and that's very much what's happened in North America. But globally, we keep hearing about, global populations growing, they're going to consume more beef and, more meat, which is true. But ultimately, demand for beef is off income. Just because if we have 9 billion people, if most of them can't afford beef, it really doesn't going to do a lot for our marketplace. But we are seeing developing countries in Asia, wealth's growing. That's where they're looking for beef consumption. And they look to import that. They can grow a lot of pork, a lot of poultry quite easily, but beef is very land extensive, so they're going to look to import that. And we're going to require, more imports and growing wealth to drive beef demand. But again, a lot of the thing that's happened in the cattle markets and beef markets is related to the competing meat sectors. If we look at globally, maybe not to downplay it, it is absolutely critical, a global marketplace that we operate in, but it isn't going to be kind of the silver bullet that's going to, be a light switch and suddenly come on. It's slow incremental changes. We export a lot of different products that we don't really consume. I've got, I think, lips, livers, tongues, all of those tripe. A lot of products that we don't consume or get at a very discount, we can get for premium prices in these export markets. And that's why we need access to as many countries as we can. We export to over 50 different countries, different kinds of beef products. But again, whether it's just all of our tongues go to Japan, for instance, livers were mostly going to Peru. It's very, very small or select cuts that may go to one country. And that's why we want access to these different countries, despite the fact, we don't have as much beef here. It's not a get-rich-quick scheme. Demand's driven off wealth. Consumption, as they move through the income ladder, they'll start with pork and start with chicken. Those are the cheaper proteins. And as they add wealth, they'll start eating more beef. And again, that's still to come as we've seen more chicken and poultry growth, global growth, production growth. And they look to import that. And as we look at these markets, the world is very good at producing more food. We've been doing this for years and years, and been doing, through my career and looking through different jobs. We keep hearing about these export markets and all the opportunities there and all these price changes, but they really haven't happened in a real big direct way that we've maybe noticed. We just continue to produce more food. As soon as we see the price signals to produce more, much like we did in 2014 in the beef and pork markets, we literally can flood the market in no time. So we got to keep that in mind as we look for these opportunities. There's a lot of global opportunities for production out there of more food. So going on to the United States, I hate to kind of point at saying, well, it could be worse as a solution, but this is the hog futures markets. If we look at hog markets in the United States, and we hear about all the volatility in the cattle markets, and they are very volatile, pork industry's actually been through a wilder ride than we have. This is going back to 2000, but 2014, that's right at the same time as the beef industry peaked, a little over 2 years ago. And within a year, pork prices went from, again, incredible highs, over more than doubling their prices, and within a year, they were at 5-year lows. Again, a lot. If we look back to 2014 and all of those factors of, the U.S. had just been through some major droughts. They'd had a huge herd liquidation. They suddenly got rain, and they flipped from pretty major liquidation to expansion, and you do that on tight cattle numbers, you decrease beef supplies. That was a big part of that big run up in 2014. On top of that, the hog industry had a big P.Ag virus. There's estimates of 8 million hogs were lost due to that virus, all at the same time. At the same time as global markets, we were exporting a lot of product at that time. And again, we saw a huge, reduction in local and in North American meat supplies, huge spike in prices. But again, it didn't take us very long. All those things that drove those prices up to those highs in 2014 were quickly corrected and happened a lot faster than I anticipated or most people anticipated. And again, we've seen the markets correct for that we've taken care of all those sort of tight supplies and overproduced that. And if we just continue on, pork prices this fall the futures got to 14-year lows. Which is, pretty stunning amount of, price levels that we thought were long gone. But if we look at the pork side of things, this fall there was concerns, did they even have enough packing capacity and labor to kill all of the hogs in the United States this fall? They look like they're through it, and there too their prices have been rebounding a little bit. But again, the hog market, they're our main competitor with a red meat market, has to work with the cattle side of things. They look to be some price recovery there, but they were killing over 2.5 million hogs per week in the United States here at their peak level. So those were record slaughter levels through the United States. And they're bringing on more packing capacity, looking at 2 or 3 big packing plants down in the United States for next year. So we know, the market's setting up. They have cheap grain. We're looking at more pork coming down the pipeline for the next couple of years, for likely, and most likely for 2017. So again, we've got all this extra meat out there. So we saw the volatility in the hog side. This is the cattle futures. It's been a little more, kind of up and then straight down, kind of a ride. Again, same thing. The beef prices peaked a little over 2 years ago, and the trend has been out there It's been fairly strong, fairly evident that prices have been trending lower for 2 years. Again, I don't know how many people here follow the futures market and can relate that to your operation, but that's one little thing. If you want to look for some, you can do all the reading you want, but you can go look at the futures market, look at some day-to-day or some weekly trends, just to get a sort of picture, what are they painting? We've got futures out into 2017 that, are pointing to lower prices right now, and they've been pointing lower for the last couple of years. They do turn. Obviously, we hit a major low in October. I'm sure cattle producers right in the kind of the heart of the fall run when we saw calf prices kind of fall apart. But we've seen them bounce back, and with that, calf prices have come back. So they definitely do relate to our local prices. But overall, we still are in a downtrending market, and we'll see. We will test that downtrend at some point here, but it'll probably be some resistance on the marketplace. So what happened in the United States after they went through their major liquidation? There's some thoughts there. You looked at the demographics, older producers. Who is going to run the cattle? Is there going to be much expansion in the United States? And a lot of the answer was kind of no, and maybe we'd have a few good years of these higher prices. Well, actually, that was kind of wrong. And when they got the rain down in the United States, they put the cattle right back out to pasture. And they've had one of their biggest expansions in about 30 years, and the most rapid expansion in over 30 years, partly because of the massive, it's a bit of catch-up rather than expansion just due to the drought liquidation. But nonetheless, these are the U.S. cow numbers, back over 30 million cows. And if you look at the beef production side, this black line is beef production. So we saw that change, the shift down in beef production. But again, we're back almost to where we were before we saw that correction in 13, 14, 15. We've got our beef production there. And if you continue to follow this herd expansion, cow numbers going forward in the United States, if they do push towards 31, 32 million cows, we actually look at the size of these carcass weights and the number of cattle out in the United States, technically there's potential we could be looking at record beef production. So the U.S. has record pork, record poultry production right now, and within a couple of years we could be looking at record beef production. So, why are these markets, taking such a tumble? Well, they're trying to absorb all this information. Not that I'm revealing anything new here, that the markets already know this, and we've got to keep an eye on that. But one thing though, in the United States this fall, they went through the expansion. Their prices fell off hard. Luckily we were a little bit cushioned by the dollar. I'll talk about that. But most of the expansion, has definitely slowed down in the United States. And, if these prices kind of stay where they are, we may see very, very limited expansion through 2017. So at least at that levels, maybe we won't see this continued increase in cattle numbers going forward. And with these prices this fall, some analysts in the United States were saying about a third of the cow-calf operators were losing money this year, or were not making money, so break even or losing money. So again, that's not expansion signals anymore. So hopefully that'll slow and we get some stability in these marketplaces. Looking at the beef trade balance, this is just showing this is again the United States. They traditionally have been a net importer of beef. They export about 10% of their production, but they also import a fairly large amount from Canada, Mexico, Australia. So they're one of their biggest importers, New Zealand. But again, for years, they were a net importer. So in the market we did see some global market strength, and again, didn't see much growth in beef production. The U.S. started being a net exporter. They were actually exporting more beef than they were importing, at a time that their beef production wasn't really growing, and that was what supported prices for a while. When their prices got so high in 2014, they suddenly, it took a little bit of a delay. 14 was the peak in markets. They really didn't start seeing their imports pick up and their exports drop off till 15, and really it was into 2016. They were a net importer. So they imported an extra 1 billion pounds more than they exported. You combine that flip from, exporting almost 1 billion pounds more. So you take that extra product that came into the country, you look at, so we produced a little less beef, but that offsets most of the decrease in North American or U.S. beef production. So again, their beef supplies have stabilized and are starting to grow quite a bit. And, really going forward, as I said at the start, we've got to look at the global market. Can the U.S. flip back to a global beef exporter? Again, their prices have sank low enough that, they are competitive, but we got to look at the U.S. dollar. But again, that trade balance definitely makes a difference in terms of, how strong the prices are. Because we know we're a very mature market in North America, especially when we talk general, probably kind of, let's call it kind of commercial beef production. We're a pretty mature market. Consumers take what they, have access to all the food they want. On the consumption side, again, ultimately what really drives prices, we always hear as prices, or if you've got more meat around, the only way to get it consumed, if it's staying in North America, which it generally is, that happens at lower prices. And again, we've seen the biggest surge. This is per capita meat consumption. So in the US, the average consumer consumes over 200 pounds of meat every year. But the green bar is poultry. That's grown phenomenally back since 1980 when we had some pretty tough demand struggles in the 80s for beef. But nonetheless, poultry consumption per capita, pork is blue and red is beef. So we know we've been producing less beef and we've seen sort of some of the trade balances. So therefore we've been consuming less beef, but we've been doing that at very high prices. So don't get it all bad that beef demand is falling, because realistically consumers are spending as much money as they ever have on beef and they're actually consuming less of it. just because there's less out there. So there is a very strong demand and willingness to pay for quality beef. So that is not such a tough issue. But again, as we add more protein to the market, that still does take your prices lower. So I like to throw this up. So, everybody's got guys with their heads down already, but if there's something we can positive look at, maybe, on the US dollar side, this is a chart of the United States dollar. And, since the election down there and all the uncertainty, generally it's been pretty strong for all markets, including the US dollar. It's had a bit of a breakout here. If you actually go back, the last time the US dollar was this strong was back in about 2002, 2003. And back then our dollar was 65 cents. So if you actually look, oil was, I think, about 35 bucks a barrel back at that time. So again, we've seen some pressure. The Canadian dollar has been on a little bit of a weakening trend, and that definitely is, of anything, that has almost more impact. If we look at futures markets, Canadian dollar can be a biggest driver to our prices, more so than even cattle market fundamentals, simply due to the exchange. So that'll be definitely a key factor to watch. If that US dollar stays strong or continues to strengthen, we could see more pressure on the Canadian dollar. We bottomed out at 69 cents last January, and then it picked up back up. But again, there's nothing to say. We can't go back to those kind of levels, maybe even a little lower. So what's happened? Again, that's sort of in a nutshell in my mind. Those are the biggest drivers and changes that we went through to see the rise in 14 and then this fall in prices over the last year and a half or 2 years. But U.S. herd expansion, record meat supplies, dollar trade balance, cheap grain. We do like the cheap grain. It's good for feed costs if you're feeding cattle on that turn of cattle. But again, that'll get bid into stronger feeder cattle prices. But on the other hand, as I've shown, if you actually look at as much pork that's coming to market and you look at the futures markets, if you look in the United States, some the projections still, despite these bigger pork numbers, the cheaper grain, that some of these pork producers are still making money down there. So again, it doesn't look like they're going to be shutting the taps off anytime soon on their pork production. And cheap grain does have more of a benefit to pork and poultry industries. They're much more grain intensive type feeding systems rather than cattle. So we definitely got to watch that side of things for the grain. Leverage, I'll talk a little bit about. We've seen that was a bit of a thorn in the side of people. Who's making the money? Retails, packers, producers. Certainly on this last turn, it wasn't the producers. And the packers and retailers have had pretty good margins. We'll talk a little bit more about that. And the theory of inelastic demand, I don't know if you got economics, somebody took economics or economics 101. This is one thing that, looking back as a thought or had discussions even on this, but not thinking it would have as much of an impact or as fast. But realistically, all inelastic demand means a small change in supplies means a big change in prices. So if we look back at 2014, we saw, I said a tightening supply of beef. We saw a big change in prices upwards. Unfortunately, the exact opposite happened. You see a small change in supplies. As you have bigger supplies, you see a big change in prices. And in a lot of theory, these markets, as much as we do hear about the complaints of manipulation and all these other things, there are a lot of fundamentals out there that are hard to counter as well. So that's the U.S. the side of things. And again, I think that has as much to do anything with the overall broader market trends we've been through. In terms of Ontario, or Canada prices, I shouldn't write much for headlines because it can't get any more straightforward than that. But it has been, quite a incredibly fast and volatile and extremely high. And biggest price changes we've ever seen. We've seen calf prices fall more than they did during BSC in the last year. And the dollars per head, we've seen feedlot losses bigger than they were during BSC. And we've never seen such big changes without some sort of other intervention in the marketplace. Interestingly, though, on the other hand, calf prices, we've always kind of been saying calf producers have been in sort of some of the best position through these markets. They've been the beneficiary of all these market signals, and that gets bid into calf prices. And calf prices do remain historically strong. They're not maybe strong compared to the last couple of years, but they're on the higher side. I started in Canfax in 2010, and the big question then is, when are we gonna get $2 calves? And while some of the things started to shape up, said, yeah, I think we can get $2 calves. Never thinking we'd get to $3.25 calves, and so everybody wanted $2 calves. Then when the calves came back to $2, nobody wanted $2 calves anymore. That was boring. And then this fall, in October, I think people were, $2 calves wasn't so bad. And, we've kind of come back to those kind of levels now. If I really want to stick my neck out, I know for cow-calf guys, selling calves at $3 was a lot of fun, and it put some money in your pockets. But overall, since that, those $3 calves didn't do a lot of other good for the industry. The guys who bought those calves didn't like paying $3 calves, and they really didn't like selling fats when they were only $1.50 after, or even less after those $3 calves were coming to town. So again, it created a lot of losses there, put prices up through the supply chain. We've seen the consumer retail prices get sort of a little bit too high, and have seen some pullback on that side of things. And ultimately, it really affects our expectations. Again, today, $2 calves is not a bad price, but compared to $3.25 calves, it's not that exciting. So from the industry, it's been a lot of a lot of adjustments to make in a short period, especially if you've made some investments, whether it was equipment or cattle or land or something like that. It's been a challenge. So again, it was nice to sell them, but it went away a little too fast, and probably again faster than we expected. To the point we had $2 fats. We've seen fats now come back to, where we started off, $1.20, $30s for fat cattle here. So it's been that roller coaster. Feeding, as I said, we had those high priced calves. Again, the feeding industry, it's kind of an all or nothing deal. They go through some loss periods. They had a really good run. As prices go up, obviously their inventory goes up and they're making more money. But again, after buying those extremely expensive calves and the market shifted on them, huge losses, basically gave everything back. Again, this assumes no risk management. This just, you're buying calves, you're buying the feed and selling fats on the cash market. There was some risk management, but it was pretty tough. There are a lot of those expensive calves. They bought those calves in 14 that really didn't work, and they turned out to be the best calves ever. Then they did that again in 15, and everything went against them. But nonetheless, the feeding sector's been in tough. We are starting to see maybe right now, finally, maybe we are getting a few dollars into some fat cattle here. It's been a tougher slug in Ontario on a basis level. Talk about that a little bit. But again, we're maybe through most of that hump. Most of those expensive calves are behind us. We've got our break-evens more in line with this marketplace today. On the cow-calf sector, again, they had a couple awesome years, no doubt about it. Depending in 16 here, this is kind of just a simple average of fall prices. I do know, there was guys, if you sold in October, potentially you weren't making might have even sold some calves at a loss this year. Overall, the average guys probably made a little bit of money as the markets, they sold in September, sold in December. But overall, again, they haven't had they've had the big fluctuations, but they're still kind of staying on the right side of the line here so far. The red line is just kind of a longer term average. Again, huge variation in here. This is just a simple little idea or a picture of maybe cow-calf sector. Canadian dollar, that's been huge. I'll show a little bit more on just how big that impact is of the dollar on calf prices. But again, it's been through quite a tumultuous run as well. It is rather interesting. If you look back to 1980, the Canadian dollars averaged about 80 cents. Interestingly, just over 80 cents. But actually, the Canadian dollar doesn't spend much time at 80 cents. It kind of either breaks through and it'll spend a couple of years below, or it goes above, below, or it becomes a bit of a resistance point, but generally it's above or below for some time. So, depending on this, and you look at the charts of the US dollar, you look at maybe, state of the economy and everything else in Canada versus the US, simple, real crude analysis would say, we're likely to stay under 80-cent dollar for a little while. That's kind of, I guess, the way I'm leaning, and, nothing to say we can't go back to 70 cents or so. I have a hard enough time given cattle outlooks. I should probably not talk about the dollar too much, but nonetheless, these are kind of the things or how I look at that picture, and that is supportive to Canadian cattle prices for sure. looking back, it's kind of interesting, have we ever seen such kind of price trends changes? Technically, actually, we have. If you go back to the late 70s, we actually doubled the fed cattle prices in 2 years. In this last turn, it took us 5 years to double Canadian, or a little less, 3-4 years, but US took them 5 years to double their prices. Late 80s, and this is sort of the one I was looking at, we doubled prices and we kind of moved along at that newer level, whereas here we've kind of gone up and taken quite a rapid decline. You go back to the 50s and back here in the early 1900s, we've seen this sort of similar we've seen prices kind of double or more in a short period of time. And in those instances, we've given up about 40 to 50% of the rally. And this goes back to 1900 Ontario fed cattle prices. And so far this time, we look at the peak price to our low, we have dropped over about 40% as well from the peak. The only thing, when these drop 40%, those are annual averages. And again, every cycle is different, every market's different, but if we took that high when we averaged 185 and 14, and then we would put us back into the averages in the mid 1.25 kind of thing for fed cattle prices. But again, we've seen other years where we didn't see those big adjustments. Just something to look at. But again, 40% seems to be a number, and hopefully that gives us some support as well in the marketplace. As much as these markets are always different, some of these historical ratios, whether we look at hog prices relative to beef, I don't have that in here, but it's sort of interesting to look. We got hog cattle prices 4 times. We looked at wholesale beef prices. They got to 4 times hog prices. We kind of were pounding our chests looking how good beef demand is, and we're into this new marketplace. Well, today we saw cattle markets and hog markets kind of fall apart. We're almost right back to that historical ratio of 2.5 times beef. So again, that's where in some of my mind that we are at these more better value points, which hopefully points to some stability. Here's the leverage scenario if we want to throw rocks right now, but you got to keep in mind when prices, took a chart out. We saw our cattle prices go up 50% in 1 year, where we only saw retail prices go up 20%. So just keep that in mind. If we look today, yes, retail prices are slow to come down, and they're not coming down as much as cattle, but they never went up as much as cattle either. But what we're seeing here, this red line is retail average meat prices, price per pound, and the blue line is the cutout. So wholesale prices, and cattle and prices follow this cutout price very close. There are times they trend apart, kind of like right now, but overall, our beef prices are tracked very close to wholesale. We like to, point fingers at packers and all their margins, but they do track. But right now we're seeing wholesale prices come down, we're seeing cattle prices come down, but retail prices are very slow to come down. And that's been a bit frustrating. That does kind of holds back the demand for cattle. If the retailer's not passing these lower prices on to consumers, they're not going to the store and going to be pulling more beef off the shelf, which kind of gets the whole supply chain moving again. We're maybe starting to see a little bit of that. We're seeing a lot more features of beef. One of the good things in this scenario is a good retail margin. Obviously, the retailer's enjoying this. They are going to promote more beef, get more beef on the shelves, get more featuring going on, and get more product moving. And that's where this leverage, it is a delay. It's been, sometimes we usually say 3 to 5 months. This time it's been a year. But nonetheless, we are seeing hopefully some of this currently get back into the marketplace and start pulling more cattle through the system. But again, they need those incentives. They definitely weren't making, we saw wholesale prices go up faster than the retail price for a while. Same with the trim prices. Hamburger was a big driver in this market. In 2014, we saw hamburger prices, huge demand as steaks and things got much more expensive. Consumers did look. They went to look at competing meats, pork and poultry, or they went to hamburger, and we saw that kind of demand drive up. And that supported fed cattle prices, supported everything. Because these fed cattle do have a lot goes out as hamburger. But again, cow prices obviously follow trim prices. And here again, we've seen cow prices, especially in Ontario, have been under more pressure here that haven't gone down as much as trim prices. But, we've seen a little bit of bounce in all of these markets here as of late. And hopefully that does add support here. We've seen our seasonal decline in cattle prices and usually see a bit of a pickup in the first quarter. And this should we're seeing really good demand again actually come back for these hamburger products. So hopefully we do see a bit of a kick in the cow market here in the first quarter of 2017. So looking at basis levels, I don't know how many people follow basis. You know, it gets a little confusing. This is a cash to futures. We always kind of look at what's our cash price relative to the nearby fed cattle futures market. And generally, Ontario's a little bit, seasonal. In the summer, you can go a premium to the U.S. futures market, and in the fall, you can go, seasonally you go below have a weaker basis. And again, you've been down. Interestingly, if we look at the markets, on the cash to futures, Ontario's been pretty seasonal from a cash to futures point of view. The only trouble is the rest of whether we look at Alberta or we look at the United States, they've had a very strong basis level, meaning that, they've been trading well above the basis. So in other words, the Ontario fed cattle market at times has been almost 20 cents under Alberta. And, quite often you're about par. Historically used to be a premium to Alberta prices. So, it's been a little bit extra tough on the feedlots here. They bought a lot of calves out of the Western Canada at times, paid the dollars on them, brought them out here, and then sold them at a discount, and that added to your feedlot losses. But again, it's that leverage component. As we saw cattle numbers increase, and I'm not sure in Ontario how much maybe the drought, we saw, saw quite a few cattle coming from Western Canada out to Ontario, whether the drought put a lot more cattle on feed earlier and kind of put more pressure and larger fed cattle supplies on the marketplace in Ontario in that October-November period. So the packers didn't have to be as aggressive on buying the cattle. But we've seen that pick up as well. Your basis has tightened up here just in the last couple of weeks, which is positive. That, your feedlots have gotten more current, and Cargill's, not bidding cattle out 3 weeks or more. Obviously they have the leverage in the marketplace, and hopefully it's coming together, and that comes more historical. But that basis does take quite a few dollars out of your feedlot pocket, and that translates back to lower feeder prices too. So all of this on the cow-calf side, ultimately we look at these charts, prices, profitability, the cow-calf sector. What has that meant for Canada? What's that done to our cattle numbers? I showed you in the U.S. they're expanding rapidly. Basically Canada's not. Hadn't shown any signs of expansion. There's maybe some hints of expansion, but no real signs, and going forward doesn't look all that positive either. Good and bad. Obviously, guys aren't sitting on. They took a lot of cow-calf producers, took those high-priced heifers and sold them and took the cash. And looking back, probably not such a bad idea there. But it's been tough for guys who did try to expand during that period. Again, we lost a third of our cow herd almost out of Canada, and we've just flattened out. Sort of interesting in Ontario. You've seen more shrinking. Our cattle numbers or cow numbers in Canada are about the size they were in early 90s. So today in Ontario, also Eastern Canada, you got about 13% of the beef cows, whereas 20 years ago in the early 90s, you had almost 20%. So again, if you look at you finish about 20% of the cattle out east, you've definitely got to rely on Western Canadian calves, and a big way to come out here to feed your feedlots. But again, overall from Canada wide, we're just not seeing any expansion. Not seeing cattle numbers go up. Heifer expansion, again, why I say going forward, we saw a little uptick in heifer retention in 2016. There was some dryness in 15 out west. There's some dry problems out here. Just can't really get the ball rolling, get the snowball going at all. And although heifer retention is up a little bit, it's nowhere near expansion phase. These are kind of basically maintain status quo. That just covers off the cows that get culled. So again, not really seeing any expansion wise, and seeing a lot of heifers going into feedlots as well. Cow slaughter, this is Canadian cow marketings, mostly driven off of the west. In the west we were up in cow marketings early in the year, way down, but we just fed a whole bunch of cows last winter when calf prices were so high. This year packers have been aggressive. As I showed, the cutout price on trim versus cow price, it's been profitable for the packer to kill cows. They have been killing cows quite aggressively in Canada. East, and most of this again is west, but your east cow kills are about steady with last year as well. So again, that bodes fairly well with a lot of, in the west, again, cheaper feed. I don't think we're going to see a huge uptick in cow slaughter there. So, again, the demand side looks pretty positive, and supplies don't look burdensome whatsoever. The other thing we've done a really good job of in Canada and the U.S., this could almost have been a factor in the first part in the U.S., is growing the cattle bigger. As I said, I guess if we put the growing cattle numbers and add on these big carcass weights, we could be looking at record beef production. In Canada, we've slaughtered 7% more cattle in Canada. It's sort of interesting, we always hear, the weak Canadian dollar, all our cattle are going to go south. Our feeders go south. It's actually the opposite. Usually a cheap dollar keeps our cattle in Canada. Both, fed cattle prices go up, so our fats become more. Packers, gain a little bit with a cheaper dollar in their labor costs. So we've slaughtered more cattle in Canada this year, and beef production, so 7% more cattle slaughter, but 10% more beef just due to bigger carcasses. So these are the weeks of the year. These are our carcass weights. And Ontario definitely has the bigger carcass weights than out west. But again, we've seen as national averages when we're averaging over 950 pounds average. That's just phenomenal. In the first half of the year, prior to this year, we had never averaged over 900 pounds once ever to have our average steer carcass weights that big. We spent most of the first quarter over 900 pounds. So we're adding a lot of beef to the marketplace. We are sort of trending down a little bit below a year ago finally for the first time in a while. The U.S. is a similar looking chart, and they've been trending below a year ago since the summer. But nonetheless, we're below a year ago, but we're still historically large, very, very large carcasses. And you got to remember, a lot of these big carcasses do carry a lot more fat, and it's a lower value product. So if we add 50 pounds to fed cattle weights, or 25 of that's, low fatty trim, the packer's gonna have to, basically the average value of that carcass weight goes down a little bit because of that extra fat. So that also weighs on the fed cattle price a bit too. And again, as I said, in Ontario, cattle numbers maybe got backed up a little bit. Your basis was pretty weak. You did have, even in Eastern Canada, you had your biggest kills out here in 2 years. And that was just barely, it's about 4 years you got to go back that you were killing, was it a little over 13,000 head in a week? So again, you had the cattle numbers out here, and again, the leverage was in the packers' hands. They had all the cattle they needed. Exports, we haven't seen as many, we have seen more fed cattle exports, but out of Eastern Canada, they've only been steady. They haven't gone up maybe like they should have to account for the extra cattle. So again, we have been running our slaughter plants quite full. And that's the weeks of the year, and these are how many cattle you're killing out east. This is the Canadian slaughter capacity to the red line. So in Canada, we can kill about 63,000 head a week. And kill a little bit more if they run a full Saturday and such. But, for a while, we were running, well below capacity. The blue line is how many we're killing, so 50, 60,000 head. And, the worry when you get into these kind of slaughter capacities versus production is, do you close a plant? And we saw that happen. There's a plant in Quebec closed, and we closed a few in Western Canada. But again, our packing plants now are running right up to full capacity. So that's kind of promising on that side of things. The utilization rates from an industry perspective is important, to the point we're actually looking at even adding a new plant in Western Canada. Hopefully should be opening in 2017, an 800 head a day plant. It's a reopening of an old one. But the other thing in Ontario, maybe with the drought and the Canadian dollar being corn-based, you haven't seen as much of a price reprieve as the United States did. And then out west, we've got a lot of feed wheat, fusarium and vomitoxin issues, and barley prices have come under quite a bit of pressure. U.S. has huge corn crop. But again, part of the thing in here is if you're based off the corn market, our weaker dollar has kept, corn prices have been more flat out here. And again, that kind of pressures back to your feeder cattle prices, competitiveness that way. Again, we've seen a little bit of relief. They're well off the old highs, but haven't seen as much as other areas. So now where to? I guess, we look at all this market information, and as I said, I kind of cheat. If we're going to do a projection or predictions, I go and look at the futures market and what it's telling us. This is just sort of the historical chart of cattle prices for U.S. side. As I said, if we have an open market like we do in North America, you take the U.S. price, adjust for the dollar, and adjust for the basis. And as we've seen, that basis can mean a lot. If the basis is $5 worse, and as I said, we were, $10 worse. $10, if you're expecting the basis to be minus 10 and it's minus 20, that's $150 a head that your feedlot doesn't get, that they were probably banking on or thinking would be realistic. So that gets passed on to calf prices. So that basis has a big impact on your calf prices too. But as you've seen through the historical cash trend, usually we have the channels and the old high becomes sort of the low, and then you go up to a new level. And to be honest, when we went up to this point on this last rally up to the US went up to 170 fats. To be honest, we thought sort of 120 was going to be the new low. But we've broken through that, and we broke, even US market broke below $1 fats, and that kind of has concern. Is their market going to go back to the mid 80s? We look at all these supplies side, that doesn't look very good. We're going to need strong demand to get these markets going. And we've seen some pickup, but again, nobody knows for sure where that price is, but we can look at what the futures are kind of pointing to. And if we look in October, so if you're selling calves in October, let's just say they're going to get finished next summer, next fall. We go and look at what are the futures saying next summer. And, they got down to that 88, 89 cent kind of level. So under $1. So if you're a feedlot, you're going to buy some calves. You're going to say, well, what can I sell them for? Figure out what's going to cost to feed them, and then they can figure out what you're going to pay for your calves. So I've just done that in a scenario here. If we look at the US dollar Fed price, it's the futures price, but we've got 100, if the US goes back to $1 Fed cattle price and a 72-cent dollar, I've got an $8 basis here, and these are just my assumptions, 85-cent cost to gain. But so if we use a Fed price of $1, 100, $1 a pound, 72-cent dollar, calves are worth about $2. And to be honest, that's kind of where our projections were earlier in the year. We thought $2 calves should hold. Well, we kind of got that wrong, but we're back there anyways. We've just been through a bit of a blip. But this is where the dollar makes an impact. You take these same assumptions, everything's the same, but you put the dollar at 82 cents, your calves become worth $1.60. Just because that's how much it affects the Fed price or what the feedlot thinks they're going to be selling their fats for. As I said, this fall in October when the markets bottomed, futures bottomed at 89 cents. The 72-cent dollar, that put calves at $1.63. But again, the scary part at that time, an 89-cent dollar, our dollar had a little bit of strength there. But if you had an 89 US Fed price, an 82-cent dollar, that put calves all the way back to $1.25. So again, these are the risks that are in the marketplace. Don't shoot the messenger, or just taking what the market had potential in mind. And if we look at the US calf prices, there was guys selling calves down there for $1.25. Heifer calves less than that, closer to $1. As I said, their calf producers were losing money. We were cushioned by that dollar. And that was kind of the fear in the marketplace. And to the point where in Western Canada, we were importing US feeders. So as tough as the markets were there, and there was Ontario buyers buying calves out of Western Canada and Western Canadian feedlots going to the States, our markets have been, relatively, we'll call, compared to other areas, still fairly strong. As disappointing as the prices were, they were still holding in there. So again, these are just the scenarios of what could happen in the market. As I said, maybe the 82-cent dollars, a little bit of a long shot now. But when I did this chart, this was a little while ago, the prices I updated was a 91-cent Fed price. The dollar was 76 cents, and calves could have been $1.53. Again, they were still probably $1.70, $1.65. Feedlots were still betting on the market improving at some point. So again, that's just how much effect the dollar has. And in simplicity, here's just a little table. If you watch the futures and they can move $1, they can move $3 in a day or more if they go on a run. But if the futures move $1, live cattle futures, when your calves are going to get finished, calf prices should move about 3 cents. It's not immediate, but that's roughly it is. Canadian dollar, every 1 cent move in the dollar, it's about 4 cents on your calf prices. So the dollar goes up a cent, calf prices should go down about 4. Again, not day to day, but on the other hand, if the dollar goes down a cent, feeder calves can go up about 4 cents. Basis, every time the basis, if it weakens a dollar, calf prices go down. So basis goes down, calf prices go down 2.5. Excuse me. But if I look at this chart and we just apply this, if we look today, this US feeder or the futures out into the next summer, fall, they're back to $1. They've come up over about 9 cents. So those futures have gone up 9 cents. So we take 9 cents on the futures, that adds about 9 cents on the futures would add about 27 cents to calf prices. And if we look at the dollar was 76 and now it's about 75, you know, so we got 27 cents from the futures helping calf prices and another 30 cents on calf prices. We've seen calf prices come up about from their very low in mid-October to being back to the $2 plus range. Again, we've seen all of this go back into the market. So why do these calf prices come up so much? It's fully driven off futures in the dollar. So if there's anything, again, takeaways is these markets, whether you believe or however you feel about Chicago and all that stuff that goes on there, that does translate right back to your prices. Feed costs, you know, whether it's barley or corn, they go down about 50 cents. You know, calf prices can go up about 10 cents for every 50-cent move in grain prices, give or take. The other one that's sort of interesting, some production things. What can you do on the market? You know, a lot of these market things you can't control. You can maybe manage it. You know, there are opportunities with whether it's contracts and futures and different things, but nonetheless, you can at least track those. There is some management things for the more advanced things, but on a production side, which again we like to focus on a lot, you know, for 50 pounds, we've seen our carcass weights get bigger and bigger. The incentive's been there for the feedlots. Again, if it's only costing them $1 or whatever, even if it's $1.20 to put on those last pounds when those cattle are big, but they're getting $1.50 and they're not getting weight discounts. Again, every pound adds more dollars, so they're getting bigger. But if you have calves that can now finish out 50 pounds heavier, so you got a steer calf here today that can, you know, he'll finish out at 1,500 pounds, and you know, you got the exact same, or two 6-weight steers, it doesn't matter the weight, and the other guy's going to finish out at 1,550 on the same conversion level. They're just going to grow that much better. You know, that calf that can grow bigger and convert better up to 50 pound heavier is worth about 2.5 cents more. Conversion, you know, biggest thing in a feedlot, you know, how many pounds of feed do they got to pump in to get a pound of grain? You know, if you get a 5% change in feed use, so, you know, if yours is 6.8 pounds conversion versus 6.3 or something like that, or 6.4, whatever 5% of that is, you know, your calves are worth 4 cents more a pound. And finally, if your death loss, good health programs, roughly, if you, let's say your calves, good health program, they only have a 1% death loss and the average in the lot might be 2%, your calves are worth 3 cents more. So you could have two calves that look almost exactly the same, but if they convert, feed better, and have a better health program, there's 10 cents a pound that, you know, is available in the system depending how you do your marketing and such. So just some little rules of thumb I like to use. So bigger picture, how am I doing time-wise? 10 minutes, perfect. Again, I think this has mostly been through this. A couple more years, you know, beef production, the way the beef supply system works, more cows, more calves in 2017. There's a lot more feeders. If you look at the feedlot, outside of feedlot supplies of calves in the States, as I said, they went through some big droughts and they haven't seen the cattle on feed go up yet. You know, if you actually look at North American wide, and I meant to touch on this, you know, in Canada, you know, our cattle on feed numbers are probably down from a year ago. The US is down from a year ago. Things are looking a little more positive here to start 2017. Cattle supplies for market-ready fed cattle are down for the first quarter. But again, there's a lot more cattle outside of feedlots, especially in the United States. They've kind of refilled the countryside, a lot of cattle out grazing and such. You know, there's over 2 million more feeders outside of feedlots in the United States versus 2014 for Jan 1. Sorry, that should be 17 we're projecting for Jan 1 17. But versus 2 years ago, 2 million more cattle, plus bigger calf crops coming. So a lot more meat coming down the line. It's going to add for meat supplies for a couple of years. Record meat production potentially for pork, poultry, and beef. I'm jumping around, sorry. Bigger calf crops. Biggest thing too, Canadian dollar, will we stay under 80 cents, 75, under 70? As I said, you know, if we're at a 75-cent dollar, we go to 70 cents. That's 5 cents that's 20 cents on your calf prices. That's a pretty major change and swing or potential opportunity. As I showed in that one trend, prices still are trending down. You know, we've seen some bounces here. Supplies have tightened up. But again, as I say, some of these other factors, I don't know if we're going to see these markets continue to collapse. I don't think so. Demand is starting to kick in at these price levels. But nonetheless, we've got all these other factors that supply side is a little bit supporting the downtrend. We continue to lose market share. There's all sorts of other market topics. I'd cover real broad sort of commercial beef. There's a lot of other market trends going on, whether it's competing meats, alternative proteins, all that kind of thing. But we are losing market share in the consumer globally as well. Consumers either turn to pork and poultry or something completely different. That's a bit of a concern in a bigger picture trend, definitely. And profitability, the last couple of years, or when prices are on a big run up, it's basically anybody who touched the cattle made some money on them. It's going to really be critical for cost management going forward, whether it's cow calf, feedlots, buying appropriately, managing risk, all that sort of thing. Touch a little bit on trade. We got back access over 30 months to Mexico. It's kind of crazy. 2003 was BSC. We just opened the border this fall in October to send beef from cows back to Mexico. So we're still having some of these small market implications. China taking, bone-in over 30-month beef. It's amazing. Today we are still having repercussions of BSC. Kind of small, but again, we're still working on some of these trade issues. We still can't ship cows, born prior to 1999. How many of those exist, don't know, but it is still a bit of a hurdle for guys feeding cows and trying to export them. So again, BSC results. EU trade deal, trying to eradicate ratification of the deal, but there's also a bunch of technical barriers, the kinds of washes the packing plants use. You need a fully certified supply chain. You can't just bring calves and say, well, they're not implanted. And EU is not just going to take any of our beef. It still has to be non-implanted, no growth promotants beef, and you need to be EU certified through the chain. So there's a few hurdles there. Definitely prices are there, but are the rewards worth and risks worth the price benefits? Just in summary, beef exports, our total volume is up. As I said, beef production's up, so we are exporting more beef. We still send the bulk of our beef to the U.S. It's over 80%. If you take all the cattle we ship down there, but U.S., Hong Kong, and China, though, Hong Kong, China, Macau has become, again, our second biggest. They kind of came out of nowhere. So again, the Asian market, Chinese imports have exploded the last few years and has been very positive globally. Australia went through a major drought, and a lot of could have put more pressure on the North American market when they were slaughtering all the cattle, but a lot of that got eaten up in China. Japan's number 3. Mexico, which used to be number 2, is all the way down to number 4, and South Korea has come back quite a bit. And they, again, had shut their border last when we had case 19 of BSC, but they've actually stepped up quite a bit. Imports, and I think those 5, it's 90, don't want to forget the number, but it's 96%, or a very large percentage. Virtually all our exports go to those 5 countries. Leave it at that. U.S., Australia, New Zealand, Uruguay, and Brazil are the main 5 importers, suppliers of Canadian beef. And as I said, we consume about 20%. We export almost 50% of the beef and cattle we produce here, yet we consume 20% of the beef we consume is imported beef. A lot of that's just geographics. Western Canada's a lot closer to the eastern or western U.S. and even parts of Mexico. So again, it's cheaper and get a price there versus trucking it east. TPP uncertainty with Trump, he's kind of saying no to that, but will there be some other deal, or will we just have to do one-on-one trade deals? NAFTA, cool. Again, Trump rhetoric has really cooled down about this stuff. I think NAFTA, a lot of that's about Mexico. Canada still has the CUSTA agreement, Canada-U.S. free trade, which still gives us pretty tariff-free access to the U.S. So I'm not sure it's going to be a huge deal. And cool, I think they've actually even removed that. That was somebody else putting that in there, that they'd bring cool back. Couple things, I guess, on expansion. As I said, we're not, haven't really expanded yet in Canada. What do we think is going to take, to expand? That's areas is the land. Areas, when markets exceed expectations, kind of 14, 15, we blew, a cow-calf producer makes way more money than they expect. That's a big expansion signal. As I said, calf prices aren't too bad right now, but it's not as appealing when, calf prices are $1 lower than the previous year. Heifers, our guy's going to keep them to breed now rather than sell them. Hearing some of that, but I don't know if it's going to be enough to change that trend. Confidence in the marketplace, that's been kind of lacking given how big and massive these swings are. Investing in a bred heifer or even keeping a heifer that's not going to give you any money for 2 years, you got to be confident in the market. Land reallocation, I know there's some of that going on in Ontario, areas for development. On the other hand, we look out west, we've fallen behind. The technology part of it affects cattle. We got, again, tractors steering themselves and all the fun and gimmicks that the grain guys have that cattle don't. Although my cows steer themselves, but besides that, we don't have as many technology advantages that side. And furthermore, the technology on direct seeding and all of these other better land use that, we're seeing more and more pasture get ripped up and can be seeded now and be fairly profitable in crop production. That's really been hurting the expansion side from a Canadian industry. And all the other land we're losing to everybody else in the world. The capital involved, technology, labor, and expertise. People have left the industry and aren't looking back. So again, these kind of don't favor expansion too big. It's going to be a fairly tough slug for expansion on the beef side. Even if we can remain profitable, are we profitable enough to the alternatives and for the labor? We do have an app because Zoetis does sponsor a Canfax app. It's only available on iPhones, but it's got some of those, sort of like that chart. If you see the dollar and the futures changing, you can punch your prices in. It kind of gives you a ballpark figure for where calf prices should be. Obviously, there's lots of fluctuations, but what I like it for is really you can go in a day or 2 days or a week later, punch in the same scenario, and it'll say, well, if the futures have done this and the dollar's done that, what do we think calf prices will be? So that's kind of all there. And you get the futures on the app as well. Finally, Canfax, as I said, we're a division of the CCA, a little plug, but we don't get checkoff dollars or government funding or anything. We are membership driven. I guess if anybody's looking for more cattle market information, it's what we do. Cow-calf operations, $150 a year to become a member. And we put out a weekly report, kind of updates, commentaries on feeder and cow and fed markets and other sort of topics of the week and online access. So I'll leave it at that. You can talk to me after, but that's my contact info. That's my spiel on that. So
thanks, Brian.